Welcome to a new IFRS Educational Fund series. It is an initiative of OJ Inspection Limited. It is dedicated to providing complementary and supplementary education on International Financial Reporting Standards IFRS through a multiple choice question and answer approach. It is intended to make learning or intellectual assurance fun. In this session, we shall be considering 10 questions to which the answers have been provided on IAS 12. This is the standard on income taxes. Viewers or subscribers have 30 seconds to select or choose their answer to each question. Please enjoy it. Question number 1. A company's motor vehicles of 90 million naira residual cost have net carrying amount of 40 million, while their tax out value is 25 million naira for reporting year end. What is the tax base of the motor vehicles for that reporting year end? A, 25 million naira, B, 40 million naira, C, 50 million naira, D, 65 million naira, E, 90 million naira. Your time counts. Ten seconds gone. Ten seconds gone. Thirty seconds gone. Time up. The answer to question number 1 is 25 million naira. The tax base of an asset is the amount attributed to that asset for tax purposes. For tax purposes, as a reporting year end, 25 million naira is the tax base for the motor vehicles. A is the answer to question number 1. Question number 2. For the tax base of a capital asset of 10 million naira with a net carrying amount of 8 million naira for the same asset, which of the following is correct? A, 2 million naira in the future depreciation of the asset will be disallowable. B, 2 million naira in the future depreciation of the asset will be allowable. C, 8 million naira will be deducted to arrive at taxable profit in the future. D, 10 million naira will be deducted to arrive at taxable profit in the future. E, 2 million naira will be added to arrive at taxable profit in the future. Time counts. Ten seconds gone. Twenty seconds gone. Time up. The answer to question number 2 is D. 10 million naira will be deducted to arrive at taxable profit in the future. 10 million naira is the future capital allowance to be granted in arriving at the taxable profit. This is the relevant amount for tax purposes, not the 8 million naira net carrying amount. D is the answer to question number 2. Question number 3. One of the following is not a reason for the recognition of deferred tax. A, the period within which an item's expense is recognized in accounting is different from the period it is recognized for tax purposes. B, the period within which income from an item is recognized in accounting is different from the period it is recognized for tax purposes. C, an item deducted in arriving at taxable profit for a period is recognized in another accounting period. D, an item added in arriving at taxable profit for a period is recognized in another accounting period. E, an item added in arriving at taxable profit for a period is recognized in the same accounting period. Your time counts. Ten seconds gone. Twenty seconds gone. Time up. The answer to question number 3 is E. An item added in arriving at taxable profit for a period is recognized in the same accounting period. All of the options from A to D are reasons for the recognition of deferred tax except for E. Deferred tax arises for either or both of 2 reasons. 1, for an item that gives rise to a deductible or a taxable in arriving at taxable profit, the period it is recognized in taxation is different from the period it is recognized for accounting. For an item that gives rise to a deductible or a taxable in arriving at a taxable profit, there's a differential on the amount considered for the item under the tax framework and the accounting framework, which cumulatively evens out in the future. E is the answer to question number 3. Question number 4. The difference between the tax base of an asset and the net carrying amount of the asset is dash. A, temporary difference. B, timing difference. C, deferred tax difference. D, allowable difference. E, non-allowable difference. Time counts. Ten seconds gone. 20 seconds gone. Time up. The answer to question number 4 is A, temporary difference. This difference is the amount upon which the future income tax implication is measured on. A is the answer to question number 4. Question number 5. Temporary difference can be multiplied by which of these rates to arrive at deferred tax? A, value added tax rate. B, consumption tax rate. C, import and export duty rates. D, personal income tax rate. E, none of the above. The time counts. Ten seconds done. 20 seconds done. Time up. The answer to question number 5 is D, personal income tax rate. Deferred tax is measured using the income tax rate. Out of all of the tax rates provided, personal income tax rate is the only income tax rate. Personal income tax rate applies to unincorporated or personal or individually owned businesses reporting deferred tax. D is the answer to question number 5. Question number 6. Under IAS 12, where an asset is not considered for income tax purposes, the net carrying amount is dash. A, less than the tax base. B, the same as the tax base. C, greater than the tax base. D, equal to 0. E, multiplied by the income tax rate. Your time counts. 10 seconds done. 20 seconds done. Time up. The answer to question number 6 is B, the same as the tax base. As the asset is not considered for income tax purposes, the tax base is made equal to the net carrying amount with no temporary difference arising or existing. B is the answer to question number 6. Question number 7. The difference between the opening balance of deferred tax and the closing balance could be dash. A, deferred tax asset. B, deferred tax liability. C, deferred tax income. D, deferred tax written off. E, A or B. Your time counts. 10 seconds gone. 20 seconds gone. Time up. The answer to question number 7 is C, deferred tax income. The difference between the opening balance and closing balance of deferred tax gives rise to either deferred tax income or deferred tax expense. C is the answer to question number 7. We'll go to question number 8. Which of the following is incorrect about deferred tax movement of a period? A, it is a component of tax expense presented in profit or loss. B, the corresponding entry goes into current tax asset or liability. C, it is a component of tax expense presented in other comprehensive income. D, the movement may be a recovery of deferred tax assets. E, the movement may be a settlement of deferred tax liability. Your time counts. 10 seconds gone. 20 seconds gone. 'Time up. The answer to question number 8 is B. The corresponding entry goes into current tax liability or assets. This option is incorrect because no entry or movement arising on deferred tax goes into current tax liability or current assets. Deferred tax movement affects deferred tax asset or liability and income tax expense. B is the answer to question number 8. Question number 9. Where deferred tax asset arises on some items and deferred tax liability arises on other items, all of the same entity, the following applies in the individual statement of financial position of that entity. A, deferred tax is not presented but disclosed as notes. B, deferred tax asset is classified under assets and deferred tax liability is classified under liabilities. C, the difference between deferred tax assets and deferred tax liability is recognized in retained earnings. D, net deferred tax is presented either under assets or under liabilities. E, the difference between deferred tax assets and deferred tax liability is recognized in provisions. Your time counts. 10 seconds gone. 20 seconds gone. 'Time up. The answer to question number 9 is D. Net deferred tax is presented either under assets or under liabilities. Where deferred tax asset is more than deferred tax liability, a net deferred tax asset is presented in the entity's statement of financial position under assets. Where the difference is a net deferred tax liability, this net balance is presented under liabilities. D is the answer to question number 9. Question number 10. One of the two subsidiaries of a Nigerian company has a net deferred tax asset and the other subsidiary has a net deferred tax liability. How are these presented in the company's consolidated statement of financial position? A, the net deferred tax asset is presented under assets, while the net deferred tax liability is presented under liabilities. B, the difference between the net deferred tax assets and the net deferred tax liability is presented under either assets or liabilities. C, both net deferred tax positions are adjusted for in non-controlling interest. D, both net deferred tax positions are adjusted for in goodwill. E, both net deferred tax positions are adjusted for in consolidated equity. Your time counts. 10 seconds gone. 20 seconds gone. 'Time up. The answer to question number 10 is A. The net deferred tax asset is presented under assets Why the net deferred tax liability is presented under liabilities? In Nigeria, there is no group tax filing. Therefore, the net deferred tax positions of the two subsidiaries are separately presented without consolidation or group netting to reflect the position of each subsidiary under Nigerian tax framework. A is the answer to question number 10. That is all for this set. Thank you for joining us for the set 1 of IAS 12 income taxes. We invite you to subscribe to our channel, share our links, and invite those in your network to do the same. This will enable you and all other subscribers get direct notifications on future video uploads. We intend to cover all of the standards in this framework and create further sets of question and answer on standards already covered. Thank you and bye for now.